Please like, share, and subscribe. Wishing you happiness and good luck every day.
So what if I told you that one of the greatest investors of all time wrote a book, not for the Wall Street pros, but for you? A blueprint designed from the ground up for beginners, a guide that could seriously change your financial future. Well, that's exactly what we're diving into today. Peter Lynch's legendary book, Learn to Earn. We're going to break down its most powerful, timeless lessons and give you a real roadmap for building wealth, one smart decision at a time. Right from the very first page, Lynch's message is incredibly simple, but also kind of profound. Investing isn't some secret club for experts in fancy suits. It's for you, it's for me, it's for everyone. He doesn't frame it as a chore, but as this fascinating puzzle, a skill that you can absolutely learn. And honestly, it can be one of the most rewarding things you ever do, both for your bank account and for your brain. And that kind of begs the question, right? A question Lynch asks right at the start. Why on earth don't schools teach us this stuff? I mean, we spend years learning about ancient civilizations and complex math formulas. But what about the one subject that will literally shape our financial freedom and our future? It's this huge, massive gap in our education. And that's exactly what we're here to start fixing today.
So, what is your greatest asset as a new investor? It's not some secret stock tip. It's not a huge inheritance. It's actually something you already have, something way more powerful than any pile of cash you could start with. The answer is simple. It's time. Okay, this is where the real magic starts. It all begins with a huge shift in your mindset. You've got to move beyond just earning a paycheck to putting that money to work for you. Think about it like this. Every single dollar you save and invest is like a tiny little employee. It works for you 24/7, never sleeps, never takes a vacation, and its only job is to build your future wealth. And the engine that powers this whole wealth-building machine? It's called compounding. Just imagine a tiny snowball at the very top of a really long, snowy hill. As it starts to roll, it picks up a little more snow, gets a little bigger, and starts moving a little faster. Pretty soon, its own size and momentum make it pick up snow at this incredible rate. Well, that's exactly what compounding does with your money. Your earnings start making their own money, creating this unstoppable force of growth over time. Now, I need you to pay close attention because this might be the single most important financial lesson you will ever learn. It sounds totally backwards, but it's true. A small amount of money you invest when you're young can become worth way more than a much larger amount invested later in life. It's all about giving that snowball the longest possible hill to roll down. Time is the fuel for this fire. And this chart right here, it shows you exactly what I'm talking about. It's a perfect picture of time and action. So on the left, you've got Chris. He starts investing at age 18 with just a small amount each year. Then on the right, you've got Pat, who waits until he's 40 to get started. Now just look at the absolute mountain of cash Pat has to invest every single year just to catch up and end up in the same place as Chris. Chris's secret weapon wasn't having more money. It was having more time. He just let compounding do all the heavy lifting for him for decades. Okay, so you're convinced. You see the incredible power of starting early and letting your money work for you. But the big question is still there. Where exactly do you put that money? What are the best places for a beginner who just wants to get started?
Well, Peter Lynch makes this super simple. When you invest, you really have two basic choices. You can be a lender or you can be an owner. Think of it like this. With a bond, you're basically acting like a bank. You lend your money to a company or to the government, and they promise to pay you back with a fixed interest payment. It's like an IOU. But with a stock, you're not lending anything. You are buying a tiny piece of the actual business. You become a part owner, and you get to share in its future profits and growth. So, lender or owner, which one has been the better choice for building wealth over the long haul? The relative safety of being a lender or the massive growth potential that comes with being an owner? Well, the history books tell a very clear story. The numbers here are just undeniable. Over this almost 50-year stretch, stocks absolutely crushed bonds. The S&P 500, which is just a fancy way of tracking 500 of the biggest companies in the US, it returned almost 12% per year. But here's the most important part. Look at that number for inflation. That's the rate at which your money loses its buying power every year. Stocks stayed way ahead of it, meaning your wealth actually grew. But with bonds, you were barely even treading water. Okay, you're in. You've decided to become an owner. You get the historical power of investing in stocks. But how do you actually do it?
What are the different paths you can take to get started on this whole investing quest?
Lynch lays out two main options, and he uses these great analogies. First, you can take the guided tour. This is where you invest in something like a mutual fund, and a professional manager does all the hard work for you, picking a whole basket of different stocks. Or you can choose to be an adventurer and forge your own path by doing your own research and hand-picking the individual companies you want to own a piece of.
And if you do decide to be an adventurer, your mission is actually beautifully simple. Find great companies. That's it. Your job isn't to guess what a stock price is going to do tomorrow or next week. Forget about all those chaotic squiggly lines on the chart. Your one and only job is to focus on the real business behind the stock. Find a successful, growing business, and over the long run, the stock price will take care of itself.
You know, Lynch has a great sense of humor, and he really uses it here to show us all the wrong ways people try to find those great companies. From literally throwing darts at the stock pages, to listening to your uncle's can't-miss hot tip, to blindly following some so-called expert on TV. He shows us exactly why these methods are just a recipe for disaster. The only one that actually works, the only reliable approach, you guessed it, doing your own research.
And here's the best part. You don't need a PhD in finance to do this research. In fact, you already have a massive advantage. You're a consumer. You see which coffee shop has a line out the door every single morning. You know which video game all your friends are obsessed with. You notice which new clothing brand is suddenly everywhere you look. That's your edge. That's your starting point for finding great companies. All right, we've covered a lot of ground, but we've saved what Peter Lynch believes is the single most important lesson for last. This one element will make or break you as an investor. It's more critical than any secret formula, more valuable than any stock tip, and way more powerful than any crystal ball.
Listen to this. You do not have to be a genius to be a great investor. In fact, Lynch says some of the smartest people he knows are the absolute worst investors because they overthink everything and they have zero emotional control. The real key, the secret ingredient, is discipline. It's about having the stomach, the patience, and the courage to stick with your plan, even when things get really scary. We all know that feeling, right? That pit in your stomach during a market crash. The headlines are screaming, crisis, all the numbers on the screen are red, and every single instinct in your body is telling you to sell everything and just run for the hills. But Lynch warns us about a far greater, far more costly danger, the danger of being on the sidelines and missing the market's best, most explosive days, which, by the way, often happen right after the worst days.
And this chart, wow, this chart is just staggering. It shows you just how devastating that mistake can be. If you had stayed fully invested for this entire 40-year period, you would have earned a fantastic 11.5% return every single year. But look what happens if you tried to jump in and out of the market. If you missed just the 40 best months, that's just 40 months out of 480 total, your return completely collapses to a measly 2.7%. You would have actually lost money to inflation.
The takeaway here is profound, but it's also incredibly simple. You cannot outsmart the market. It's just not possible. The biggest gains are sudden, they're concentrated, and they are completely unpredictable. Trying to dance in and out is a fool's game, and the data proves it. So, what is the ultimate secret to successful investing? It's not about timing the market, it's about time in the market. It's about being patient, staying the course through all the inevitable storms, and just letting the incredible power of great businesses and compounding work its magic over years and decades.
So there you have it. The 4 keys to successful investing, straight from one of the greatest to ever do it. These are the core principles from Peter Lynch's masterpiece. Number 1, start as early as you possibly can. Number 2, choose to be an owner. 3, do your homework on companies you can actually understand. And number 4, and this is the big one, have the discipline to stay in the game for the long haul. It really is that simple. Because at the end of the day, investing is about so much more than just making money. It's a fundamental shift in your perspective. It's about becoming a part owner of the future. It's about having a real stake in the growth and the innovation of the very companies that are shaping our world. The only question left is, are you ready to be an owner? You know, it's kind of crazy when you stop and think about it. Your job, your paycheck, that mortgage payment, even the idea of owning stocks in a company. All of it feels so normal, like it's always been this way. But the truth is, in the grand sweep of human history, these are all brand new inventions. For most of our time on this planet, the world of capitalism just didn't exist. So today, we're going to peel back the layers and see how this whole system really got started.
So here's the journey we're about to go on. We'll start in a world that literally had no concept of money as we know it. Then we'll see how risky adventures gave birth to the very first corporations. From there, we'll watch the absolute chaos of the first market bubbles, see America try to build its financial system from scratch, meet the Gilded Age billionaires who basically owned everything, and finally, land in the modern world of big global brands. It's going to be a wild ride, so let's jump right in.
All right, let's kick things off by hitting the rewind button. We're going way, way back. Before paychecks, before Zillow, before the hustle. We're heading to a time when the basic rules of how you lived your life were completely, and I mean completely different from today. It's a world you'd barely even recognize. This slide just lays it out so clearly, doesn't it? For thousands of years, if you were alive, you were probably a serf, a slave, or a servant. There was no direct deposit, no browsing for a new house. The very idea of getting ahead in life simply wasn't a thing. In fact, trying to get rich was seen as, well, sinful. The church taught that actively chasing wealth was just a fast track to greed and eternal damnation. And charging interest on a loan, oh, that was a huge no-no. They called it usury, and it was considered one of the worst sins imaginable because you were literally selling time, and everyone knew that time belonged only to God. And this system, this way of life, it was locked in place for centuries. You didn't buy a castle, you inherited it through your bloodline, or you took it by force. That was it. But by the late 1700s, you can start to feel the ground shifting. Trade between nations started booming, and out of that, a whole new class of powerful merchants began to rise up, challenging the old aristocrats whose power was all tied up in land. And the bankers, who used to be shunned, started to become really important players. The world was right on the edge of something totally new. So, with this new age of exploration and discovery, a brand new problem pops up. These voyages across the ocean to the New World, they were incredibly expensive and super risky. So who in their right mind was going to pay for all of this? We have this image of brave explorers setting off on grand adventures. But let's be real. From day one, colonization was a business, a high-stakes business venture. The famous names you learned about in history class, they weren't footing the bill for their own ships. Nope. The money was coming from shrewd investors back in Europe who were gambling on the hope of getting a massive return. And the solution they came up with was, frankly, ingenious: the joint stock company. It's basically the great-great-grandfather of the modern corporation. The idea was simple. Instead of one rich person risking everything, you sell little pieces of the company, shares, to lots of different people. It spreads out the risk and lets you raise huge amounts of cash. The Dutch East India Company perfected this, funding massive fleets that came back loaded with spices. They even funded the voyage that famously bought Manhattan Island for 60 guilders. Now, take the Pilgrims. We know their story as a quest for religious freedom, but they had a very worldly problem. They were flat broke. They couldn't afford a ship, supplies, anything. So they cut a deal with a group of London investors who called themselves, fittingly, the Adventurers. And the terms of this deal, they were absolutely brutal. The Pilgrims had to agree to work for the company 6 days a week for 7 straight years. After all that time, if there were any profits, they'd be split. They were basically indentured servants to their own shareholders. So get this. For the investors, the whole thing was a total financial disaster. The colony just bled money. After years of losing cash, the investors had had enough and just wanted out. So they sold the entire operation to the Pilgrims for £1,800. And since the Pilgrims were still broke, they bought the company on an installment plan. And just like that, the iconic story of American religious freedom also became the very first leveraged buyout in American history. The workers literally bought the company. But as you can imagine, this new world of stocks and investing had a very dark side. The promise of getting rich quick is a powerful drug. And it led to these moments of collective madness, speculative manias, where common sense went out the window and entire fortunes vanished overnight. We call it a bubble, and the pattern repeats itself throughout history. It starts with some story, some hopeless proposition that captures everyone's imagination. Frantic investors pour in their life savings, prices for shares shoot up to insane levels, and then, pop. The crash comes, and it is always brutal. A perfect early example was the Mississippi Company in France. This smooth talker named John Law convinced everyone that Louisiana was basically paved with gold. It wasn't, of course, but by the time anyone realized, the bubble had burst and taken the entire French economy down with it. But for sheer insanity, nothing beats the South Sea bubble in England. As the main company's stock went to the moon, all these copycat companies popped up, and their business plans were just absurd.
People threw their money at a company for a perpetual motion machine, a company to turn sawdust into lumber, and my absolute favorite, a company carrying out an undertaking of great advantage, but nobody can know what it is. It was literally a secret, and people gave them their money. It's unbelievable.
And lest you think it was just gullible, everyday folks getting caught up in this, think again. Sir Isaac Newton, yes, that Isaac Newton, one of the greatest scientific minds who ever lived, invested a fortune in the South Sea Company, and he lost it all. His quote says it all, doesn't it? I can calculate the motions of heavenly bodies, but not the madness of people. It's a timeless lesson on how powerful herd mentality can be.
So after watching all of this financial mayhem unfold in Europe, the brand new United States of America knew it needed to get its own house in order. But how to do it? Well, that question kicked off one of the fiercest debates in the nation's history.
This slide really gets to the heart of the conflict. It was basically two competing visions for what America should be. On one side, you had Alexander Hamilton. He argued that for the country to be strong, it needed a modern financial system, a national bank, public credit, the whole shebang. On the other side was Thomas Jefferson. He hated cities and factories. His ideal was a nation of small, independent farmers, and to him, banks were basically the root of all evil, a tool for the rich to corrupt the nation. This argument, this tension between Hamilton and Jefferson, has echoed through American history ever since.
And right around this time, in 1776, a book comes out that changes everything. The Wealth of Nations by Adam Smith. He introduced this radical idea of the invisible hand. Here's the gist of it. Smith argued that you don't need a king telling everyone what to do. If millions of people just pursue their own self-interest, the market will magically organize itself for the benefit of everyone. Think about it. If a town has too many hat makers, hats get cheap. If there aren't enough bakers, bread gets expensive. So pretty soon, a few of those struggling hat makers will switch to baking. The problem solves itself. It was the intellectual foundation for modern capitalism.
So America basically goes all in on this free market idea. And in the late 1800s, the Gilded Age, the engine of capitalism went into overdrive. The country saw growth like never before, but it came with a huge problem. All that wealth and power started to get concentrated in the hands of a very, very small group of men.
Even Adam Smith warned about this. He knew the biggest threat to his system was the monopoly. And honestly, the board game is the perfect way to understand it. We've all played it, right? What happens when one player owns all the railroads and Boardwalk and Park Place? The game's over. They can charge whatever they want, and everyone else goes broke. That's a monopoly in the real world. One company gets total control, crushes all competition, and can set whatever price it feels like.
And these men, these were the masters of the game. They got the nickname robber barons for a reason. Carnegie in steel, Vanderbilt in railroads, and of course, John D. Rockefeller in oil. These guys didn't just get rich. They built empires and amassed fortunes so vast they would have made the kings of old look poor. They were the undisputed titans of this new industrial age. Rockefeller's strategy, which he perfected with something called a trust, was brutally effective. He'd go to his competitors and give them a simple choice. Join my trust, or I will crush you. He'd sell oil for so cheap that no one could compete, driving them to the brink of bankruptcy. And one by one, they folded and joined him. Eventually, his Standard Oil Trust controlled 90% of the oil in America. He could set prices for everyone, from his customers to the powerful railroads. But you can only push people so far. Eventually, there was a massive backlash. The public got fed up. They realized the economic freedom they'd been promised was being strangled by these giant monopolies. This gave rise to a whole new movement of journalists and politicians, the trust busters, like Teddy Roosevelt, who finally used new laws like the Sherman Antitrust Act to break up these massive companies and try to bring competition back. And that whole trust-busting era was a real turning point. It set the stage for the 20th century, which saw this incredible shift in the economy. We moved away from the heavy industry of the Gilded Age, all that steel and oil, and toward the consumer-focused economy we all live in today, an economy built on hamburgers, movies, and software.
This table just tells the entire story, doesn't it? Look at the original Dow Jones average from 1896. It's all companies that made stuff. U.S. Rubber, Tennessee Coal and Iron, the building blocks of a nation. Now look at the list today. McDonald's, Disney, Microsoft, Coca-Cola.
It's a complete transformation from an economy of gritty production to an economy of brands, services, and digital information. And look at that. Only one company, the legendary innovator General Electric, managed to survive on that list for more than a century. That alone is just an incredible story of adaptation.
So in what is really just a blink of an eye in human history, we've journeyed from a world where making a profit was a sin to a 24/7 global marketplace. We've seen corporations born from adventure, manias that wiped out fortunes, and battles between titans that defined a nation. It has been a messy, chaotic, and truly revolutionary story. And it is definitely not over, which leaves us with one big question. What's the next chapter?
Welcome to The Explainer. Today, we're diving into the basics of investing. And look, if you're young, we're about to show you why your single biggest advantage isn't money. It's something you've already got tons of: time.
All right, so here's what we're going to cover. First, we'll talk about the real cost of putting this off. Then we'll get into a great story about 2 different ways to spend your money. After that, we'll break down your main investment options, get you into the right mindset, and then, the best part, show you how to actually get started right now. First things first, let's talk about the single biggest roadblock for most people, and that's the temptation to just say, I'll do it later. We're going to see why later is a very, very expensive word.
You know, the material we're digging into today kicks off with this pretty serious warning. And it's not just to scare you. It's a simple fact. Every single year you wait is a year your money isn't out there working for you, growing in the background while you go about your life. Those are years you can never get back.
So, what's the big deal? What does it actually cost you to wait? Well, it's not just some number on a page. It has a huge impact on your future, on your freedom, and on the kind of life you'll be able to build for yourself down the road.
I mean, we're talking about the difference between a retirement where you can travel and do what you love versus one where you're constantly worried about making ends meet. The sources are super clear about this. You just can't live it up on Social Security alone. And the path you end up on, it's determined by the choices you're making right now.
Okay, to really drive this home, let's get into a little story. It's a classic tale about 2 coworkers, 1 really cool car, and a financial decision that changes everything. All right, so meet Joe and Sally. They work together, and they both got a couple grand saved up. Joe takes his and puts it down on a brand new Camaro. Now he's got a car payment, $400 a month for the next 5 years. Sally, though, she does something different. She buys a perfectly good used car for her 2 grand cash, and that $400 a month, she starts putting it into a stock mutual fund.
Okay, let's fast forward 5 years and see how they're doing. Let's start with Joe. After all his payments and interest, he spent about $26,000 on that Camaro. But cars, as you probably know, lose value the second you drive them off the lot. His once shiny car is now worth maybe 5 grand, so his investment actually cost him $21,000.
Now, what about Sally? Well, she was faithfully putting her $400 a month into that mutual fund. The source shows that over those 5 years, her investment grew pretty nicely. With her contributions and the growth of the market, her account is now worth $28,000. She didn't just spend money, she turned it into more money.
And here's the bottom line, folks. This one choice completely changed their financial paths. Sally now has a real asset, enough for a down payment on a house. She's building her future. Joe? Well, Joe's got an old car and he's still living at home.
Okay, so you're sold on the why. You see the power of investing. But the next big question is, where in the world do you actually put your money? Well, the source breaks it down into 5 main buckets.
First up, we've got the stuff you probably already know about. Savings accounts, CDs, things like that. These are super, super safe. Your money is insured, you get paid a little bit of interest. It's the perfect spot for your emergency fund or for money you know you'll need in the next year or so.
But here's the rub for long-term growth. The source calls this the inflation treadmill. Just look at this chart. In 1980, your money market account paid 12.7%. Sounds amazing, right? But inflation, the rate at which prices go up, was 13.5%. That means even while earning interest, your money was actually losing its buying power. To really build wealth, you have to beat inflation.
Next, let's talk about physical stuff you can own. You've got collectibles, like rare comic books or stamps. These can be amazing, but you really need to know what you're doing. A much more common one is housing. Buying a home is often the single best investment people make, mostly because, well, you can live in it, and you can use what's called leverage, basically the bank's money, to buy it.
All right, from physical things, we move to financial paper. And first up are bonds. Think of a bond as a fancy IOU. You are lending your money to a company or a government, and they promise to pay you back with interest. It's generally safer than stocks, but here's the trade-off. Your upside is capped. You know exactly what you're going to get and no more.
And that brings us to the big one, stocks. This is a total game changer. When you buy a stock, you're not just lending your money. You're buying a piece of the action. You become a part owner of a real business. If that company succeeds, you succeed. And unlike a bond, there's no limit to how much your investment can grow.
And this chart, man, it just lays it all out so clearly. Over a long period, from 1945 to 1994, government bonds got you about 5% a year. Not bad. But look at stocks. Big company stocks got you almost 12%. Small company stocks even more. That difference over a lifetime of investing, it is absolutely massive. Okay, so knowing where to put your money is one thing. But the real secret sauce? It's all up here, in your head. It's about having the right mindset. And for a young person, that mindset starts with one powerful idea. Your most valuable asset is time. This is maybe the most important sentence in this whole explainer. It's not just a nice idea. It's a mathematical law. It's because of something called compounding. It's like rolling a snowball down a hill. Your money earns returns, and then those returns start earning their own returns, and it just gets bigger and bigger and bigger.
And this image just makes it crystal clear. Look at Chris on the left. He starts with just $2,000 at age 18 and invests a little bit as he goes. Then you've got Pat on the right. Pat waits until he's 40 and has to shovel a massive $8,500 a year into his account just to try and catch up. And guess what? They both end up with the same amount of money at retirement. That, right there, is the magic of compounding. Chris's money just had way more time to work for him.
So the whole idea is to be a long-term investor, not a market timer. The market timer is the person who's glued to the screen trying to guess the daily zigs and zags. They freak out when things drop and end up selling when prices are low, which is the exact opposite of what you want to do. The long-term investor just buys pieces of great companies and hangs on for the ride. It's discipline, not genius, that builds wealth. All right, we've covered the why, we've covered the what. Let's bring it all home with the how. How do you actually get started, like right now, today? You've basically got two main routes you can take. The first is through mutual funds. This is kind of the let a professional handle it option. Your money gets pooled with a bunch of other people's, and a pro invests it in hundreds of different companies for you. Super simple, instant diversification. The other path is the adventure of picking your own stocks. This is more hands-on, you're doing the research yourself, but it can be incredibly rewarding. And the best part? You do not need a pile of cash to get in the game. The source has some fantastic ideas. Next time it's your birthday, instead of asking for a new pair of Nikes, ask for one share of Nike stock. You can also look into programs where you can buy stock directly from a company. Or join an investment club and learn with a group. You can even start a fantasy portfolio and practice with fake money just to get the hang of it. At the end of the day, it all starts with that first step. And when it comes to investing, your greatest weapon, your secret sauce, is time. You know, there's an old saying, the best time to plant a tree was 20 years ago. The second best time is now.
Welcome to The Explainer, where we take big, complex topics and turn them into clear, visual stories you can actually understand.
You know, it's kind of funny, but a company is a lot like a person. It's born, it grows up, it matures, it has its good years, its bad years. It faces all these challenges and triumphs along the way.
So today, we're going to follow that incredible journey. We're going to trace the life of a company, right from a simple idea, all the way to becoming a global force.
We're going to break down the whole life cycle into 6 key stages. All right, let's dive right in with stage 1. It's honestly amazing when you think about it, right? So many of these massive billion-dollar companies, they didn't start in some fancy high-rise. Nope, they started in a garage with just one bright idea and a ton of grit. And look no further than Apple for the perfect example. We're talking 1976. 2 college dropouts, Steve Jobs and Steve Wozniak, see a future that pretty much nobody else could. What was it? A personal computer in every single home. So they just got to work, right there in a garage, messing with circuits and transistors to build that very first machine. And how'd they fund it? Well, they literally sold everything they had. An old van, a couple of calculators, that's it. And with just $1,300 of their own cash, they managed to build the first 50 Apple computers.
I mean, that is the definition of bootstrapping.
Okay, but you can't stay in the garage forever, right? To really grow, founders have to climb what's called the funding ladder. It starts with them using their own savings. Step 2, if they get lucky, they find an angel investor, a rich friend or relative who takes a long-shot bet on their vision. And then finally, once the idea is actually proven to work, the pros come in, the venture capitalists. Now, here's the catch. At every single step, they get the cash they need, but they have to give up a little more ownership of their baby. And for us, for the average person, this is the stage we only ever read about years later. You can't really invest in it, but it's where the giants of tomorrow are being born.
All right, let's move on to the next stage. This is a huge, huge step for any young company that's looking to really level up. It's the moment it steps out of the garage and onto the world stage.
So how do they do that? Through something called an initial public offering, or IPO. Basically, it's when a company decides to sell little slices of itself, we call them shares of stock, to anybody in the public for the very first time. It's how they raise some serious money to expand, and it's such a big deal, it's often called the company's second birthday.
And here's a really interesting, kind of weird piece of Wall Street lingo for you. When a company goes public, the big investment banks that handle the deal publish this ad in the paper. And get this, it's called a tombstone. It's a funny little quirk, right? For a person, a tombstone marks the end of their life. But for a company, it marks the very beginning of its public life.
And this slide right here perfectly shows the risks involved. I mean, Apple's IPO was a smash hit. It sold out in an hour. But then, the initial hype died down and the stock price actually tanked. It really goes to show you, even for a company that becomes a legend, the road is never a straight line up.
So, going public gets you the cash to grow, but man, it does not guarantee your survival. Just like a person, a company can hit a rough patch in its middle age, a point where all the things that used to work suddenly just don't anymore.
And Apple's story is a textbook corporate midlife crisis. Right after their big IPO, they launched the Apple III, and it was a total dud, a lemon. Then came the Lisa computer, another flop. The company's reputation was in the gutter. Its stock got crushed. But then, right when they were facing disaster, they launched the Macintosh, and with one of the most iconic ad campaigns ever, they staged this unbelievable comeback.
Okay, so what happens after the crisis and the big comeback? Well, after years and years of just explosive growth, even the most innovative companies, they mature. They become these established giants, and that rocket ship expansion, it naturally starts to slow way down.
Wall Street actually has this term of endearment for these big, established, prestigious companies. They call them blue chips. The name comes from poker, right? Where the blue chips are the most valuable ones. The name kind of implies this permanent quality, like it's a company you can just count on forever and ever. But history is just littered with cautionary tales. Take U.S. Steel. It was once the most powerful company on the entire planet, but decades later, its stock was worth less than it was back in the 50s. Or General Motors and IBM. They were the definition of blue chip, but both of them saw their dominance just fade away, their stock prices flat for decades. It's a really powerful lesson. No company, no matter how great it is, stays on top forever.
And now we get to the juicy stuff, the drama. In the later stages of a company's life, there's always a lot of action with other companies. We're talking mergers, acquisitions, big battles for control. It could be a total soap opera.
So sometimes one company just straight up swallows another one. We call that a takeover. Now, if the company getting bought is happy about it, it's a friendly takeover. But if they fight it tooth and nail, well, that's when it becomes a hostile takeover. But either way, the goal is always the same. The company doing the buying gets at least 51% of the shares, so they have majority control and can call all the shots.
All right, for our last section, let's zoom out a bit, because no company exists in a bubble, right? Its entire life, from beginning to end, is shaped by the world around it, what we call the economic climate.
It's like, think about plants. They need the weather to be just right to grow. Well, companies are the same. They need the economy to be just right. If the economy gets too hot, you get inflation, prices going up everywhere. If it gets too cold, you get a recession, a big downturn. That sweet spot in the middle, that's the Goldilocks climate. Not too hot, not too cold.
Now, this is super important, so really pay attention here. Recessions, those cold periods, they get all the scary headlines, and on average, they last about 11 months. But just look at the flip side. Economic expansions, the warm periods, they last an average of 50 months. That's almost 5 times longer, and they create way more jobs than are ever lost in the downturns. The big takeaway here is all about perspective. The engine of growth is just so much more powerful than the brakes of a recession. The good times are longer and stronger than the bad.
So this whole economic cycle, it creates these conditions in the stock market. You've probably heard these terms. A bull market is when prices are just stampeding uphill and everyone's feeling confident. A bear market is the opposite, when prices fall 25% or more from their peak, usually driven by fear. And yeah, they're painful, but bear markets are a totally normal part of the cycle. They happen about once every 6 years, on average.
And that brings us to maybe the most important takeaway of this whole thing, and it's captured perfectly in this quote. I mean, we all wish we could predict the downturns, right? Get out just before things go south? Well, the problem is nobody can do it consistently. And the data shows that when investors try, they almost always end up doing more harm than good. Why? Because they panic. They sell at the bottom, and they miss out on the market's best days, which, funny enough, often come right after the worst ones. The temptation to time the market is massive, but it's a game that very, very few people ever win.
Which leaves us with this final thought. We've just walked through the entire messy, complex life of a company, from a dusty garage all the way to a global giant that has to navigate these huge economic storms. And given all those unpredictable ups and downs we've seen, this whole journey seems to suggest that maybe, just maybe, the wisest strategy for anyone investing in them isn't about timing, but about time.
All right, welcome back. Today, we're going to talk about something fascinating, a massive shift in how fortunes are made in America. I mean, you can basically forget everything you think you know about old money. The names, the stories, even the entire playbook for getting rich. It's been completely torn up and rewritten. So let's get right into it. You know, for generations, this was pretty much the accepted wisdom. Rise early, work hard, strike oil. J. Paul Getty's formula. It paints a picture of a very specific world, right? It's a world of tangible stuff, oil literally gushing from the ground, huge shipping empires, fortunes passed down through these famous family names. It was all about inheritance and heavy industry.
So the big question is that old money playbook still the way to the top today? I mean, really? Or has a totally new kind of tycoon with a very different origin story completely taken over? That's the question we're going to try and answer.
Okay, so here's our game plan. First, we'll look at the changing face of the super rich. Then, we're going to unpack some of these wild, sometimes totally accidental origin stories of brands you know and love. After that, we'll dig into some pretty startling data about who's actually creating jobs in the economy. And to wrap it all up, we're going to ask a tough question. Who do we, consider our heroes today? All right, let's jump right into part one. We're talking about a truly monumental shift here. It's this move away from wealth that's just handed down, generation to generation, to wealth that's built from the ground up, and often from the most unlikely beginnings you can imagine.
Okay, and here's the proof. It's pretty stark. If you look at the Forbes 400 list from 1982, it's just packed with those familiar old money names, right? We're talking Rockefellers, DuPonts, Gettys. The word inheritance actually showed up 65 times in the descriptions. Now fast forward just a little over a decade, and boom, the list is completely transformed. You've got self-made guys like Bill Gates and Warren Buffett at the top, and the number of inherited fortunes, it dropped by a third. The whole idea of the American dream was literally changing before our eyes.
And get this, these new tycoons, they weren't products of privilege, not at all. So many of them started at the absolute bottom. I'm talking mailroom clerks, traveling salesmen, JCPenney trainees. And just look at the number of dropouts. You've got college dropouts, high school dropouts, even an 8th grade dropout. But listen, they weren't dropping out to mess around. No way. They were dropping out because they had an idea and they just couldn't wait to go build it.
And the sheer scale of this new wealth was just mind-blowing. By the mid-90s, the price of admission to get into this exclusive club, the Forbes 400, it had tripled to $300 million. So the real story here isn't just that different people were getting rich, it's that they were getting rich on a scale that was honestly just unimaginable before.
But you know what's really fascinating? It's how little all this new money seemed to change them. I mean, take Sam Walton, the guy who founded Walmart. Even when he was a billionaire, he was famous for driving this beat-up old pickup truck and living in a pretty modest house. And you see that again and again with this new class of tycoons. It was this relentless focus on the work, not all the fancy stuff that comes with being rich. So let's move on to our second section and see how all this happened. We're going to look at the founder's playbook, and let me tell you, it's full of these bizarre, accidental, and totally brilliant stories of how some of the most iconic companies in the world even got started. The story of Coca-Cola is a perfect example. It didn't start in some fancy boardroom. It started in 1869 in a bathtub as a brain tonic. It was sold for just $2,300 to a druggist who had the brilliant idea to start building the brand. Decades later, it was actually American GIs in World War II who accidentally became its best global advertisers, turning it into an icon. Then you have leaders like Roberto Guizetta pushing it into nearly every country on Earth. What a journey, right? Full of accidents, smart moves, and just relentless ambition. And Coke is not alone. So many of these huge brands started as happy accidents. Wrigley's gum? That was just a freebie to help sell baking powder. Levi's jeans were originally made from tough tent canvas for gold miners. And Campbell's soup? That only exists because a brilliant chemist decided to work for his uncle instead of taking a fancy university job. It just goes to show you that billion-dollar ideas are often hiding in plain sight, disguised as something else entirely.
Now, for a totally different kind of playbook, let's look at something more modern and way more countercultural. This is the amazing story of how two hippies who met in gym class ended up creating an ice cream empire.
Ben Cohn and Jerry Greenfield's path was, well, anything but traditional. After a string of odd jobs, they spent $5 on a mail-order course about how to make ice cream. They opened their first shop in an old gas station. And get this, when they needed to grow, they didn't run off to Wall Street. They sold stock, but only to people living in Vermont. They wanted to keep the company local. It was a path that was all about community and being a little quirky, and man, did it work.
And then you have the story that basically defined the digital age. This one isn't about bathtubs or gas stations. It's about a couple of teenage hackers who saw the future in a computer lab.
The Microsoft story is just incredible foresight and strategic genius. I mean, Bill Gates and Paul Allen were true pioneers. They drop out of college, create a brand new computer language, and then they make the deal of a lifetime with IBM. They agree to build the operating system for IBM's new PC, but, and this is the whole shebang right here, they insisted on keeping the rights to the software for themselves. That one decision, that is why Microsoft, not IBM, became the absolute titan of the software world.
So, we've seen how these founders built their massive fortunes, but what was the ripple effect? What about their impact on the rest of the economy? Well, our third section here reveals a really surprising truth about who was actually creating jobs in America back then.
Back in the 80s and 90s, all you heard about in the news was downsizing. And the numbers? They were pretty grim. A sample of 25 of the big, established American corporations, they cut over 420,000 jobs in just one decade. They were all trying to get leaner and meaner. It really felt like a national crisis.
But hold on, because that is only half the story. While those old giants were shrinking, a whole new generation of high-growth companies was absolutely exploding. And that exact same time period, a sample of 25 of these newer entrepreneurial firms, they didn't just replace those lost jobs, they added over 1 million new positions to the workforce.
And these original tables really show the data behind that incredible turnaround. So on the left, you've got the established giants. If you look down the columns for employees, right here and here, you see the numbers are mostly flat or even going down over that decade. Okay, now look at the table on the right for the high-growth companies. The employee numbers are just skyrocketing, in some cases growing 10 times over. This wasn't just a small trend, you guys. This was a fundamental power shift in the American economy. The engine of job creation had completely moved.
And it wasn't just about jobs, it was about overall growth. The big, established companies, they grew their sales by about 1.7 times over the decade, which is, respectable. But the smaller, entrepreneurial firms, their sales grew by a jaw-dropping 7.2 times. They weren't just hiring people, they were fundamentally reshaping the entire economy with their innovation and their speed.
So all of this data about job creation and economic growth brings us to our final and maybe more philosophical question. In a society that values contribution, who do we consider our real heroes? Given the economic reality we've just laid out, the answer, well, it might surprise you.
Okay, think about this. We celebrate cultural heroes like the legendary quarterback Joe Montana, and for good reason. His talent brought joy to millions and, supported countless businesses around the sport. But let's look at a different kind of hero, a business leader like Lee Iacocca. When he saved Chrysler from going under, his actions directly saved an estimated 300,000 paychecks. That affects a whole ecosystem of suppliers, dealers, workers, and their families. It just raises an interesting question, right? How do we weigh these different kinds of contributions to society?
Now, I know what you might be thinking. What about the crazy amounts of money these leaders make? But it's really important to understand where that money comes from. It's usually not from a giant salary. It's from owning stock in the company they built or that they lead. So that means their personal fortune only grows when the company's value grows, which also benefits every single other investor, from big funds all the way down to regular people with a 401k. The whole structure is designed to tie their success directly to the success of the company. It's a win-win.
And so that leaves us with this final thought. In an economy that's been fundamentally reshaped by entrepreneurs who create brand new industries and millions of jobs, what's our definition of a modern hero? It's definitely not a simple answer, but it's a really vital question to think about in the world that these founders have built. Can you imagine trying to pick stocks when you were basically flying blind? Not that long ago, that's exactly what it was like for the average person. Getting good, timely information was a massive challenge, and it put you way, way behind the pros. But today, the game has been completely turned on its head. We've gone from a world where information was scarce to an absolute explosion of data, and it's all right there on the device you're probably using to watch this. So, let's dive into how this incredible transformation actually happened.
Here's our roadmap. First, we're going to travel back in time to see what it was really like investing in the dark. Then, we'll watch the digital information explosion unfold and see how it gave us some incredible new tools, including what you might call a dating service for stocks. We'll also look at how we can finally decode the complex world of mutual funds, explore the massive world of resources we have now, and wrap it all up by talking about what this all means for you, the empowered investor.
All right, let's set the scene. Before we all had computers and the internet, the small-time investor was at a huge disadvantage. I mean, the pros at the big Wall Street firms had all the latest info, but that info rarely made its way down to the little guy. So if a hot buy recommendation suddenly flipped to a sell, you were probably the last person on earth to find out, long after the big money had already gotten out.
And just look at how painfully slow the whole process was. Imagine this. On day one, you get excited about a company and call your broker to ask for a research report. A full week later, something finally shows up in your mailbox. But guess what? The analysis is already months old. So the very next day, you have to physically drag yourself to the library to try and find something more current, spending hours squinting at these giant, dense books with tissue-thin pages full of financial data. It was just a slow, frustrating grind.
So what did you actually have to work with? Well, your toolkit was pretty limited. You had the official annual and quarterly reports from the companies themselves, those stale analyst reports from your broker, and then a couple of key resources you'd find at the library. The big one was the Value Line Investment Survey, which is still a fantastic resource, by the way. It packed a ton of info about a company onto a single page. Then there were the Standard & Poor's reports, which were kind of similar, but gave you a lot less analysis and opinion, and that was basically it. That was your whole arsenal.
And then, everything changed. Welcome to the digital information explosion. When the personal computer showed up, it set off an absolute supernova of financial data. All of a sudden, information that used to be locked away on Wall Street started becoming available to everyone, and new services were popping up left and right to deliver it.
And this slide just lays it all out, doesn't it? We went from information being scarce to a total information overload. Your broker went from being a gatekeeper you had to rely on to being a useful resource who could pass along data right from their screen to you. And that slow slog of waiting for the mail or trekking to the library, that was replaced by instant online access. It was a whole new world.
Now, if you were lucky enough to have a home computer back then, you could tap right into this world yourself. The pioneers were services like America Online, Prodigy, and CompuServe. They let you get stock prices instantly, read company news, and catch up on industry reports, all without ever having to call a broker. I mean, this was the real beginning of the revolution, giving regular folks their first taste of real financial power.
Now, one of the absolute coolest and most powerful tools to come out of this digital explosion was something called a stock screener. And honestly, the best way to think about it is with this fantastic analogy that just makes the whole concept click.
So what exactly is a stock screener? It's simple. It's basically a super powerful search engine for stocks. You tell it the exact things you're looking for in a company, and this tool sifts through a massive database of thousands upon thousands of companies to find the very few that perfectly match what you want.
And this quote just nails it. It really is like a computer dating service for stocks. Instead of looking for a partner who has a great sense of humor or loves to travel, you're looking for a company with specific financial traits. You're trying to find your perfect investment match out of a universe of thousands of possibilities.
And here's how it works. You could literally tell the computer, hey, show me every single public company that has zero debt. Boom, you'd get a list. Then you could say, and on top of that, their earnings have to be growing at 20% a year. The list gets smaller. You could go even further, and they need to have a ton of cash, and the stock has to sell for less than $3 a share. In just a few seconds, the computer spits out a targeted list for you. You have to realize, before computers, a search like this was totally, completely impossible. Now, it's a piece of cake.
And hey, this information revolution wasn't just for stocks. It also brought a whole new level of clarity to the super confusing and often overwhelming world of mutual funds, where you've got thousands of different options all competing for your money.
So a few key players stepped up to help investors figure this all out. You had financial magazines publishing detailed reviews comparing different funds and their risks. And two major research companies, Morningstar and Lipper, became absolutely essential. Think of it this way. Morningstar gives you the full story on a fund, kind of like Value Line does for a stock. Lipper, on the other hand, is all about the numbers, tracking and ranking performance.
So here's the key difference, and this is what you really need to know. If you want the complete story, a deep dive into a fund's strategy, who's managing it, what the risks are, you go to Morningstar. But if you just want to know who the top performers and the bottom performers were in a certain category last year, you look at the Lipper rankings in papers like the Wall Street Journal. Both are incredibly useful, they just do different jobs.
So we've got stock screeners, we've got way better mutual fund data, but that was just the start. A whole ecosystem of new tools and services popped up, giving the individual investor a toolkit that was more powerful than anyone could have ever imagined before.
I mean, just look at this slide. This is only a small taste of what became available. You had services like Bloomberg, where you could listen to interviews with CEOs and get news updates faxed to you. Can you imagine? You had online directories like Nelson's with data on thousands of companies from all over the world. You could even get free online access to official government filings. The amount of information at your fingertips was just staggering.
And what's really important to remember is that even if you didn't have a computer at home, you still benefited from this information boom. The quality of the resources at public libraries and your local broker's office got so much better, with huge research books and catalogs that the average person could never have gotten their hands on before.
So, let's bring it all home. What's the end result of this huge, decades-long transformation? What does all this data, all these amazing tools, actually mean for you as an investor today?
Well, it all boils down to one simple, incredibly powerful idea. The playing field has been leveled. That huge information advantage that the professionals used to have over everyone else, it's been drastically reduced. Regular people now have access to the same high-caliber data and powerful analytical tools that used to be for Wall Street insiders only. And this number right here, this says it all. Just one of those resources we talked about, Nelson's directory, had data on over 15,000 public companies, and all of that information was suddenly searchable by you, the individual investor. The barrier to doing serious, in-depth research was completely torn down.
So we've gone from anxiously waiting by the mailbox for a single, outdated report to having the entire global market at our fingertips. The journey for the individual investor has been nothing short of revolutionary. We have the tools, we have the data. The power is truly in our hands now. So the only real question left to ask is the one you see right here. Thanks for tuning in.
When you open a company's annual report, it can feel like you're staring at this dense wall of text and tables. But if you know where to look, you'll find that the financial reports aren't just a bunch of numbers. They are the complete, unvarnished story of a company's behavior, its struggles, and, well, its triumphs.
And that right there is the core idea we're going to explore. We are going to learn how to read the story that's written in the language of numbers, specifically on a company's balance sheet.
So to really bring this to life, let's follow the story of an entrepreneur. His name is Barkley. He's a research scientist out in Silicon Valley, and he's just built this amazing new gadget in his garage called the Interface. It literally lets you command any personal computer with just your voice. We're going to join him right at the very beginning and watch his company, CompuSpeak, grow from the ground up.
So here's the journey we're about to take. We're going to trace the 5-year history of Barkley's company by looking at 4 really pivotal moments in its life. And with each step, we'll see exactly how the company's story, all its challenges and its breakthroughs, gets captured perfectly on its balance sheet.
Okay, let's start at the very beginning. Day 1, the birth of CompuSpeak.
Now, to fund this dream of his, Barclay has taken a $100,000 second mortgage on his house. So the big question is, how does that personal loan translate into the company's official books?
Well, this is where the balance sheet comes in. Just think of it like a financial snapshot in time. On one side, you've got assets. That's everything the company owns. And on the other side, you have liabilities and equity, which is everything the company owes, both to outsiders and to its owners. And here is the golden rule. They must always, and I mean always, balance. That's the fundamental equation of accounting. Assets must equal liabilities plus shareholder equity.
And here it is, CompuSpeak's very first balance sheet. See how Barclay's $100,000 is split up on the asset side? $50,000 is just sitting there as cash, and the other $50,000 he immediately spent on machinery, which is listed as property, plant, and equipment. So, total assets, $100,000. Now look over at the other side. Notice the company itself has zero debt, so liabilities are zero. That means the full $100,000 is listed as equity. And what do you know? Both sides balance perfectly.
Now, this $100,000 investment is officially called paid-in capital. It's the money put directly into the business by its owner. And see that little piggy bank for retained earnings? It's totally empty. That makes sense, right? That account is for all the accumulated profit a company keeps, and on day one, CompuSpeak hasn't sold a single thing or made any profit yet.
Okay, so when Barclay put that money in, he also issued himself shares of stock. And here's the thing, the number of shares is completely up to him. He just decided on 10,000 shares, which made his initial ownership stake worth $10 per share. But honestly, he could have issued 1,000 shares worth $100 each, or even 1,000,000 shares worth 10 cents. At this stage, it's really just a way of slicing up the ownership pie.
All right, let's fast forward 1 year. CompuSpeak has been making and selling the interface, and now the story gets a lot more interesting. The business is actually up and running, which means some new characters, or, new accounts are about to show up on our balance sheet.
Whoa. So the balance sheet at the end of year one looks a lot more complex. Suddenly we have new assets like accounts receivable and inventories, and this new liability called accounts payable. We also see two really important new items, depreciation and, for the very first time, a profit showing up in retained earnings. Let's break down what all this new stuff means.
Let's start with these two, because they're really two sides of the same coin. Accounts receivable is an asset. It's the $19,500 that customers owe CompuSpeak for interfaces they've already bought but haven't paid for yet. It's money the company is pretty confident it's going to collect. Now, accounts payable is the flip side. It's a liability. It's the $10,000 that CompuSpeak owes its own suppliers for things like parts and electricity.
Hey, remember that $50,000 in equipment Barclay bought? Well, machines wear out, they get old, they become less valuable. That process is called depreciation. The IRS gets that this is a real cost of doing business, so it lets companies account for it. After 1 year, Barclay's equipment gets written down by $10,000. So it's now valued at $40,000 on the books, and that $10,000 loss in value actually counts as a tax-deductible expense. And get this, it's a non-cash expense, meaning no actual money leaves the company, but it still reduces his taxable income, which is a huge deal. And here it is, the company's first taste of success. After you account for all the sales and all the expenses, including that depreciation, CompuSpeak made a profit of $4,500. Now, Barclay chose not to pay himself a dividend. Instead, he reinvested that money right back into the business. And because those earnings were retained by the company, the profit now shows up right there on the balance sheet, finally putting a number in that retained earnings account.
Now we get to a really crucial moment for any startup. Business is good, but to get to that next level, Barclay needs way more cash than his small profits can provide. This is where CompuSpeak's strategy for growth really begins to take shape. So, in year 2, he turns to the bank.
Take a look at the liabilities section at the end of year 2. A huge new item has just appeared, $121,000 in bank debt. This time, it's not Barclay's personal mortgage. The company itself has borrowed the money to pay for a big expansion. More machinery, more inventory, more staff. This is a major strategic shift.
And this reveals a really critical distinction. Borrowing money increases your assets. The company gets cash. But it also increases your liabilities by the exact same amount. The bank doesn't become an owner. They're just a lender. Barclay still owns 100% of his company. This debt is basically an IOU that has to be paid back. It doesn't give the bank any slice of that ownership pie.
Okay. Now let's jump ahead to year 5. And whoa, the picture has changed dramatically.
Compass Peak has totally transformed. It's expanded its factory, sales are booming, and somehow that entire $121,000 bank loan has vanished from the books.
So this presents a puzzle, right? If the company's profits weren't big enough to cover it, how in the world did Barclay find the cash to both eliminate a huge debt and fund a massive expansion? Well, the answer, as always, is right there on the balance sheet. You just have to know where to look.
The big clue is in the equity section. Check out paid-in capital. For years, it was stuck at that $100,000 Barclay initially put in. But by year 5, it has absolutely skyrocketed to $700,000. That's a $600,000 jump. So, where did that new capital come from?
Simple. Barclay sold a piece of his company. To get the cash he needed to grow without being strangled by debt, he decided to bring on a partner. He went out and found an investor who was willing to bet big on CompuSpeak's future.
And here's exactly how that deal went down. The investor injected $600,000 of fresh cash into the company. In exchange for that cash, CompuSpeak issued 5,000 brand new shares of stock. So now, with a new total of 15,000 shares out there, the investor owns 1/3 of the business, and Barclays still owns the other 2/3. It was a classic trade-off. He gave up some ownership to fuel his company's long-term success.
So the balance sheet, it really gives us the core plot of a company's story, where the money comes from and where it is at any given moment. But to get the full narrative, you've got to look at the other reports, like the income and cash flow statements. They're the ones that add all the color, the detail, and the action to the story.
You know, Barclay's 5-year journey has really shown us a few core truths. We've learned that a balance sheet isn't just some static list. It's a dynamic story. We've seen that fundamental equation, assets equal liabilities plus equity, hold true at every single stage. We watched the story get richer as new accounts appeared once the business started operating. And maybe most importantly, we saw the 2 primary ways a company can fund its growth, either by taking on debt, which is a liability, or by selling ownership, which is equity.
So you now have the basic tools to read a balance sheet. You can actually look at a financial statement and see beyond the raw numbers to the real story underneath. A story of decisions made, risks taken, and a business being built from the ground up. So the next time you look at a company you admire, ask yourself, what story are its numbers trying to tell me?